Something else, maybe, I don't know. That's the way.
Is geophysics by training. You worked on experimental design, geoelectrics, and other topics, but today you're working in the reinsurance company, and I'm looking forward to your presentation about another aspect of natural hazard and impact on society.
So thank you for inviting me, and yes, I think, so quickly on me, I have a background in geophysics. I did a PhD in actually in geoelectrics and postdoc at ETH. I was sharing an office with Hans-Rudi Maurer, by the way, so that I was doing my postdoc. And then after that, I left to go to the dark side of the business, doing in the industry, I would say. And yeah, those days, I spent 16 years in risk management solution, RMS, which is, maybe I have an intro, just if I can see, yeah. Which is one of those big modeling companies where we create those natural catastrophe models. As you can see quickly on the company, it has been founded in late 80s. All those companies have been founded late 80s. RMS has been founded as a startup at Stanford. And then at the time, I think nobody understood why those scientists in earthquake, engineers were doing at the time. And especially on the business, insurance companies thought they had all data they need to manage the risk and so on. And then they had the Hurricane Andrew, they had the Northridge earthquake happening, and then half of the insurance company disappeared in the US, and they said, oh, maybe those guys at Stanford, they're not that crazy, we need those tools. And this is all this kind of business of catastrophe modeling, this CAT modeling, as we mentioned, started. And now you see we are one of those companies providing this modeled view. So we are not an insurance company, we are not a reinsurance company, we are not bearing any risk. We are not providing, we are only providing an independent perspective about the risk. And if you want, the metrics we produce out of our model are the metrics that are used for the risk trading, as you will see. So it's important to be independent from that perspective, right? So we are a bit like the euro or the US dollar of the risk trading. Everybody knows on this insurance market or the banking market what the RMS loss for earthquake in Europe or in Portugal is, as an example, right? And it's a benchmark. So you see, I will talk today a lot about natural catastrophe. I try to talk a little bit about earthquake modeling, but it's a very risky way because you are all expert. I'm not, right? I think especially I've been working mostly at RMS on the climate and weather risk side, so the hurricane, the flood, the hail, and the things like that. But as you can see also that we are covering other stuff, right? I think terrorism has been a big business, and we do the same modeling for human terrorism activities as we do for earthquake, and that's interesting. Cyber has been emerging, and also the pandemic longevity, especially with the COVID, it's a big topic. So yeah, I mean, at RMS, this is maybe important, and you can talk about that. We are a heavily scientific-based company, so we're hiring quite a lot of geophysicists, geographers, climatologists, wind engineers, and so on. This is the profile we have, about 400 of those guys there, and they are doing the model. And personally, I've been involved in the product management team. My team was leading the design and the whole life cycle of those big models, if you want, right? Understanding what the market needs, this industry needs, translating that into the development project, interacting with the scientists, which were actually coding and creating those models, and then the go-to-market, bringing that to the market, explaining to the market how the model works, and making sure they can put that into action. So that's a little bit my role and the role of this company there. So, I mean, probably one thing I just want to make clear is that we are, I'm a bit changing scale, maybe to what you have seen, right? I'm no longer interested in what's happening to one landslide on one, territory. Here we talk about really catastrophes, which is by definition, so they are even that could affect a complete region, a complete country that could cost multi-billion of US dollar of economic losses. And basically, it's the part of the risk that you cannot avoid, right? I think the insurance market starts with believing you can reduce the risk to a certain level, but there is always a part of the risk that you have to manage after that, right? And this is this residual risk we are talking about. 2011, let's say in Japan, or even the earthquake we had in New Zealand was, or even the flooding was, of course, like a big element. Another example is probably like on terms of the earthquake risk is L'Aquila in 2009. It's a pretty old kind of date for an earthquake, but it's pretty interesting to see that even in Europe, we have a big problem, which is what we call the protection gap, meaning there is a lot of perils that are not insured. So if you look the difference between the economic losses that was estimated after that earthquake and what is actually insured by the market, there's a big difference, right? And this gap is a problem because if you have not an insurance system in place, you cannot, if you want, finance the risk. And the problem is that after a big event, you just rely on what the states will do for you. And the state is doing very little because, you know, they maybe go on the side, they show themselves on the TV and so on, and then 2 months after, they have other stuff to do. And I'm pretty sure people in L'Aquila, they live still in temporary lodging at this point of time, right? So it's really important to understand that at some points you need to have like a system in place and an insurance system in place. And actually the model, the fact that you can model the risk is very essential, because if you cannot really model the risk, you cannot understand the risk, manage the risk, and offer, let's say, an insurance system. And this is where models are really essential from that perspective. So if you look the kind of evolution about those catastrophic losses with time, it's interesting to see first, of course, it's increasing. So a lot of this increase is due not only to the earthquake risk, but a lot to the climate risk, as we call it, like let's say flood and typhoon, hurricane, and hail. Recently, this is, of course, there's an obvious signal of climate change, but I just want to tell you this increase is due to the fact that we are more and more living in a very dangerous way, right? We build where we should not build. Everybody wants to have a house in front of the sea and of the river. They got flooded, right? That's a big risk, and this increase is actually a big increase in exposure, and more than an increase in the hazard purely, if you want, right? But you see also the difference between what is insured and what is not insured is still very big. We estimate that about 1/3 of the risk, the nat cat risk, is actually insured, I would say, globally, right? Okay? That's just to give you an idea about this protection gap. So the models are very important to manage this kind of risk, if you want. So why do we need model? That's a good question, right? Because you can see you have a lot of data, and this industry could do something out of that. And I just want to start with one example, which is not really earthquake driven, but it's a little bit more. It's very local. It's with the kind of windstorm we can have in Europe. This is this kind of big extratropical cyclone, and you may remember the windstorm Lothar we had in '99. I'm old enough to remember it, but maybe not you. That's showing I'm very old, right? So, but that's basically the idea. In '99, they had another storm that was part of this cluster we had in December, and this hits basically more Denmark. That's what we call the footprint. That's integrated maximum wind over the lifetime of a storm. So you see it hits very, very high wind speed Denmark. And it's interesting because if you look at the insurance system in Denmark before this windstorm Anatole, nobody were caring about storm. They had some data. They had already some storms in the past, but nothing big. And suddenly again Anatole happened, and again the market was hit very severely. And you could see it's completely transformed the need of insurance and reinsurance coverage on the market. Then after Anatole, you have seen the storms happening. Christian in 2013 as an example. But the question, of course, is Anatole just one outlier, or is it really something we can expect to have bigger? So that's a question, because our loss history is very limited, right? The catastrophic loss history, we have a lot of windstorm that happens every day or every month during the winter. But at the point is that it's very limited in terms of the storm that would happen on average every 200 years or 500 years. That's the same for earthquake, right? We probably have not observed that yet. So one way to manage the risk is to use this kind of historical record, if you want. And what people do in actuarial science, in the insurance, they try to do this kind of incidence probability curve. Sometimes it's showed that way. I'm showing this that way, where you have basically the losses on the x-axis and, the return period on x-axis and the losses in y-axis. And they say, okay, I'm plotting all the data I have in Denmark, maybe over the past 40 years of the length of my historical catalog. I observed one losses, the biggest, which costed me maybe 30 millions. So the return period is 1 in 40 years, right? That's the empirical return period. Then the second storm is Erwin. And we have, of course, 2 storms in excess of that loss, which is Erwin itself and Anatole. So the return period is 20 years. It's 2 over 40, and so on and so forth. You can build this kind of empirical curve, and you understand when you come to very small storm, this is becoming pretty stable because you have a lot of data. It's exactly what you would do when you want to manage a car accident, as an example. You have thousands of accidents every year, right? So you have a lot of data. But when you come to the tail, this is really a problem. And you can see that it's very unstable. We don't have a lot of data, right? So the core role of what we do here is really to create, if you want, synthetic event or additional event that looks like the real ones. So it's a physical modeling of the risk. There is not a lot. It's not just a pure statistic modeling. We will create windstorm. We will create earthquake, model that, and understand, for example, what kind of event could happen in Denmark every 200 years, as an example. We have never observed that, but we expect to be able to model windstorm that looks like actual ones we observed, very mild or small, but also the big one that we never observed and that could completely damage the country, as an example, right? So the role of the scientific work we do is really to create this kind of models, if you want, right? And to give you a sense, those models, they are actually used by any player in this market. So, of course, we are more here. We have something to insure. We buy insurance to some companies. They will use some model to understand what is the risk, how to set up your premium. They will buy also reinsurance. So what the reinsurance is, probably in the room, you don't know exactly what it is. You may have heard about Swiss Re as an example, or Munich Re as a name, but actually it's pretty esoteric because we never are in touch with those guys. But our reinsurance is only an insurance for insurer. Basically, that's what it is. And so they buy that. They need also modeling. Sometimes the broker that trade the risk, they need that as well. And sometimes even the banks, they use that as well. So at every steps, we need models. The idea, of course, is to be able to transfer the risk across this risk transfer chain, if you want, right? And why we do have reinsurance, by the way, it's just because everyone is trying to diversify the risk to stabilize the losses. An insurance, probably like it may be operating only in Germany or only in Switzerland. So if there's a big storm happening in Switzerland, they are basically killed, if you want, right? So they need to mix their business with other stuff. And this is why reinsurance, we basically take a bit of wind in Switzerland, earthquake in Japan, there's no correlation between the two, and it destabilizes basically, of course, the losses. That's the role of this risk transfer chain. But the idea, of course, is that you need at every steps to have a model to manage this risk. So, and by the way, I think in these logos, there are scientists doing this modeling, right? So I know sometimes I'm doing some kind of lecture as well on the topic at different universities, and it's always interesting to see that it's not very known that actually like Zurich Insurance or Allianz or Swiss Re, of course, maybe you know, they have a big team of developers and scientists to build those models actually, right? So that is a big business. So the question now is how do we build those models? Actually, we follow a pretty logical scheme all the time, right? I think we need to build, of course, as you understand, those synthetic events. So we call them the stochastic event set. with a specific hazard, if you want, right? And this is this collection of hundreds of thousands, sometimes millions of earthquake. We model a windstorm, hurricanes as an example. Each of those, they need to be located somewhere. They have a certain magnitude, so a certain intensity and a frequency, which is designed as the rate. Of course, this is where the hazard part happen, right? We need, of course, to build a vulnerability model to transform that hazard into a damage. And from that perspective, we need, of course, to basically include exposure into that topic. And then after that, we need to compute some financial metric out of that, because what we are interested is losses, right? Okay, so that's really the process we follow. And actually, most of the job of the people there is really to try to find how to patch some deficiencies in terms of losses, sorry, in terms of data and in terms of information, and building some tools to go around that, because it may be one, I know I have those 3 questions to answer as well, but one of the key questions we have, the key problem our engineers and scientists have, is basically to take very sparse data and try to build something that is coherent, not only just for one region, but across Europe, as an example, right? And this kind of homogenization or transferring information is a real challenge. So one thing we need to do, I will show you a little bit about those models, but of course is to characterize the risk or the buildings, if you want. And there is a lot of work of standardization we do in terms of doing that. So we need to, if you take, let's say, a certain location, we need to understand where it is. It sounds very obvious, but it's not actually, because very often we don't know where the risk is. It's maybe an insurance company know the address of a building, but then in this risk transfer process, this information is lost. And the reinsurance, very often they have to work with aggregated data, and they say, okay, I have maybe 10 risks in the canton of Graubünden. I don't know where they are somewhere. So I don't know. And for flood risk, as an example, that could make a big difference, right? So this is the kind of problem they have. So we need to also develop tools to retrieve this lost information. Then we need to code those buildings. So we need to know how much they are valued, the replacement value, to rebuild them. This is usually coded in insurance policy. But then, of course, there's some specifics around what this building is used for. This will be driving the vulnerability of the content. Of course, the content in a single-family home is different than in a hotel, as an example, the value of the content. And then maybe it's more obvious for you, of course, the type of construction, right? If this is bricks on masonry or concrete, we need to know that. And again, this is not obvious. Sometimes we don't have this information. We need to have specific tools to retrieve that information, but it's very critical. And then other information like the number of stories, the age of the building. So all these kind of things need to be standardized, and there's a lot of work to happen already in terms of data enrichment and characterization of the for specific portfolio at an insurance company. Then once we have that, of course, we need to retrieve this kind of information, and the model work only in terms of lat long. So, but the risk can be entered as a city, as a Cresta, which is the equivalent of a canton for us in Switzerland, or a state in Germany, as an example, right? A Bundesland. So we need really to be able to retrieve this lat long from that. So we have specific data enrichment engine to develop. And of course, the more you have an accurate location and data quality, the more you decrease your uncertainty. So the model will be able to deal with that. But that's just an example about all the challenges we have. So we have a specific geocoding teams that work only on data processing, enrichment, and understanding how to translate an address into a lat long, which depends on the country where you are. It's sometimes less obvious than others. Then once we have this risk, or those buildings that are standardized, we can characterize the risk. So here, just to give you an example, a few of the things we do. If you take like creating a model for earthquake in Europe, we use, of course, we are not developing any geophysical data, right? We will just read what you produce at university, what scientists are producing in terms of attenuation function, in terms of geological studies, in terms of fault description, and we try to integrate that into a common framework. And once we I've collected as much data we can, we generate some new earthquake. That's not very traditional. It's maybe things seismologists do at DTH, as an example, where we have to create, for example, along a fault system, you can generate different rupture length or area, link that to a certain magnitude and that to a certain frequency of occurrence and so on. So we create, let's say, a lot of earthquake along the fault systems. We create also earthquake for background seismicity where we have never observed any faults, right? We need to try to be as complete as possible. And then, of course, we generate, of course, the hazard, right? I think, and that's just going into this processing of creating, let's say, hundreds of thousands of events, understanding how the ground motion is attenuated, trying to characterize the soil. So this is how we will also collect a lot of geophysical, geotechnical data, you know, about soil property to understand how soil can amplify the signal typically. And then, of course, we go, I'm going a bit fast here because I'm pretty sure you're all familiar with that more than me. We go, of course, then over all this kind of modeling, like typically understanding how this translates into peak ground acceleration or spectral acceleration, I would say, which is a much more adequate way of dealing, especially with tall buildings, right? So that's just a very traditional way of modeling things, but the idea is that we try to do it. I would say at this point of time, it's not different to what seismologists are doing, right? When they create, let's say, 250 hazard maps for earthquake, they do a lot of this kind of modeling anyway. That's not extremely different. Maybe it's more exotic if you talk about hail, but for earthquake, that's a lot of done. This kind of hazard part is very much done in research centers as well already, right? So, but we have to do it also for our own needs. If you take about another peril to give you something a bit less I would say executed or research in the academic world. That's typically the topic of severe convective storm, which is a mix of hail, summer straight line winds, and tornadoes that we could have. Here again, we need to create this stochastic event set. We need to create this collection of events, and here we have again the same problem that usually we don't have a lot of data to do that, right? I think there is, so the first role of the scientist there will be, of course, to try to map any existing data we have and try to understand how we can represent severe convective storm event like a hailstorm that are extremely localized and that is probably missing a lot of weather observation station. So we have very few data. We may have some ground truth indicator of hail because we have a network of people observing hailstones, right? And they can record that. But of course, it's not very homogeneous spatially because not everyone is doing that everywhere, right? But it's a true indicator of hail. And as another example, we have reanalysis radar data, we called about that, right? Where we can map a whole region or country with a series of radar information. But of course, it doesn't give you a true indicator of hail size typically on the ground. You can derive some rule to say this kind of radar signal can lead to 2 to 3 centimeters of hail, but that's not a true indicator. So the role of the scientist will be to try to find a methodology to mix this kind of very heterogeneous data, if you want, okay? And we end up finally with finding solution around that. So I just want to give you a sense about how we work with that. We try, of course, to calibrate those models into the reality. So we use a lot of things that is very, I would say, useful and developed by research centers or locally. And this is where maybe the work we do is interesting because if we can take what you learn on a specific site and you can generalize that to our needs on a continental level, as an example, that's very interesting. If you think about landslide as an example, we'll probably not have any seismic data for every landslide in Europe, right? But if you derive some relationship between the type of geology, maybe the slope, maybe some factors around that, then we can derive some rule to basically map the risk of landslide at a continental scale. That's a little bit what we do here. For example, in France, they have some detectors, if you want, some polymer plate to record the hailstone size. So we can use that data, even if it's not only available in one part of France, for the rest of Europe, because we can use that to calibrate on hailstone model. Another challenge that is really interesting is the fact that some of that risk is moving. Typically cars, they are moving, right? And cars, they need to be insured. So and hail is a big driver for damage to cars. So what we do usually, usually when cars got destroyed in hail, they are usually not at the address of the homeowner, right? Of the owner. They are somewhere on the motorway or on a parking lot or this kind of thing. So typically here scientists, they need to think about, collect data again about traffic statistics in Europe and try to model some kind of in a probabilistic way the fact that cars, typically personal car in the morning, they go in the city center and maybe in the evening they go back to the suburb, and this is where the convection is maximum and they got hail, and they need to create a model like this. When we're developing those models, I was working with a Dutch insurance company, so they only have insurance in the Netherlands, and they were saying to me, look, I mean, I have only people in the Netherlands, but my big hail losses happens in Italy and in France, where the Dutch people are on holiday there. And this is exactly, so you understand a bit the problematic of this kind of risk, and you need to find these kind of connections. And so it's very applied science, I would say, but that's very pragmatic way of solving those issues. Okay, so imagine we could spend a lot of time creating or explaining those models, but we have now this collection of synthetic events, if you want, and now for each of those events and each of those exposure, we need to translate the hazard at this point, at those buildings, into a damage, and this is done, as you know, through the vulnerability model. The vulnerability is actually designed to be mapping a certain hazard. It could be like a spectral acceleration or peak wind speed to a damage, the mean damage ratio actually, and the mean damage ratio is defined as the average loss with over the replacement value. The replacement value we have, it's entered by the user, it's the value of the house, and the mean damage ratio is given by the model, so if you reorganize this simple equation, you get the loss, and this is exactly what we want to do, right? That is very simple in theory. In practice, this is a nightmare because we need to create curve for any kind of type of buildings, right? Depending on the type of construction, again, you can imagine we don't have data everywhere. I mean, you have maybe good data in one country, not in another. You need to find a relationship between the building stocks in Belgium, in Germany, or in Switzerland, and that's the way. Usually, I think the hazard model is developed by climatologists, statisticians, things like that. Those guys, they like old Gaussian curve and stuff like that, and then they pass the model to the vulnerability guy that said, yeah, it's plus or minus 20%. You know, there's a clash sometimes between the two teams, right? But that's the way it happens, right? They need to do with the data they have. And by the way, you can see this, some of my colleagues after big event, they go on site, I would say, to observe how the building reacted and to improve the model that way. So they collect, in this case, we collect our own data, I would say. We need to build that for the building, the content, business interruption, of course. If you cannot operate a business due to an earthquake, that maybe even if the building is still intact, but you no longer have any power, you need to be paid by insurance for that, for the loss of the business. So we need to model that as well, which makes the thing very funny sometimes because typically we had a case like Dell in Texas, as an example, was affected by earthquake by the Thailand flood in Thailand. Nothing to do, but they didn't get any microchips to build computers, so they had to stop at the Dell in Texas, and this triggered a US policy. So you need to try to map those teleconnections as well, which is very much a nightmare, as you can imagine. And then, of course, earthquake is not only shake, we have all kind of other sub-perils. So the idea is that if you map all of that, in the end, you get something that is a bit complicated because you get hundreds of curves to build because it's a combination of all those different factors. Each time you need to be able to map what's happening there. And also one thing that is a bit funny is that when we talk about vulnerability, we don't talk about fragility, and this is probably all what we have in mind here. The fragility is the purely engineering reaction of the building. If you shake two houses, one, let's say, in Germany, the other one in France, same houses built by the same guy, the same day, with the same material, the same house, they have the same fragility statistically, if you want, but they don't have the same vulnerability because in between you have all the market and social cultural factor. The taxation system is different between the country. The insurance system is different. And even the behavior of people is different, right? Some countries, I don't want to name them, are frauding more than others, right? So they will basically claim for losses. Some governments saying, oh, there's a big loss, do a good gesture to the people, everything below 2,000 euro will be paid without any control. That's the guarantee from us. So guess what? Everybody will call for 1,500 loss and something like that, which inflates the losses. So we need to model this kind of elements. In the end, what we create is a loss model, right? And of course, we need to take into account all uncertainty to that. Just to give you a sense, I just added these slides now because we discussed a lot about the sensor uncertainty, which is important for us to translate into our model. Of course, we are never sure, depending on the device. So the countries are using different devices. Some of them, they measure different type of data, which needs to be all translated into a unified system, and this induces an uncertainty. And there is and it's the uncertainty in the sensor, it's uncertainty in the hazard as well. We cannot really understand why that building is intact and not the other one because of liquefaction, as an example, but that's the reality. There will be always some uncertainty here. And then even if you fix conditionally to a certain measurement, you still have uncertainty into the damage as well, right? And this is the reality. Some part of the buildings are still intact, some are not. Some houses after the hurricane are intact, some are not. Maybe this house was built on Friday evening. People were just fed up to go to the weekend. They just quickly finished the house, and then nobody noticed, right, until there's a hurricane and the house explodes, right? That's exactly what you see in this kind of spread, if you want. The model can deliver this kind of insight as well, okay? And then the financial modeling happened when we can create those curves. I don't want to enter too much into the details, but this is where you will be able to create those events that could happen every 50 years, 200 years, and so on. And just to give you a sense, this is typically, it's the key metric this industry is using. This is the probability of exceeding a certain loss, right, any given year or in terms of aggregated way. They use that typically to price reinsurance. For example, when they want to transfer a part of the risk, they design this system. I don't have time to enter too much into the details, but they will use those points to actually price and trade the risk. So it's very important. This is really well grounded in reality, the best we can. And this also, it's used a lot for regulation as well, because those insurance companies, they have to prove they are solvent, they have enough money in the bank if there's a big catastrophe. So they use some of those return period loss to be reported to the regulatory authority, right? And it shows also one thing in terms of the methodology we have to implement. It needs to be extremely documented, extremely transparent, because everything will be scrutinized. When you issue, let's say, a quake model or wind model for Europe as an example, and you say, okay, the model is released in May, maybe it will be used only 12 or 16 months after that, right? This is the time the scientists at the insurance company will take to validate, check, create benchmark, and so on the model until they put that into action. So our scientists, they need to develop documentation. When they develop a very original piece of research, they publish in peer-reviewed journal. This is a very strong, if you want, a statement for us. If we can say to a user, this has been peer-reviewed, this shows there is some robust way we've done that, right? Because we have basically the consensus of the academic community. And I'm pretty sure maybe you may meet now some of my colleagues from Moody's on RMS at EGU. They go very often to publish paper there as well, especially on the hazard side. And some of that, we do also some repeats, as if we have to reconstruct as well historical events, so that the clients, sometimes insurance company, they like to run what if this earthquake happens again on my book of business, how much it will cost to me. That's the kind of stress test they do, okay? So to give you an example, I just want to watch the time because I don't want to okay. It's typically the kind of analysis we can do for one building, but you can imagine this is a big computing effort because we may have millions of buildings times millions of events to run, so that's a big effort, but for one single risk that I've taken here in this example, the Roche Tower in Basel, You can code a number of stories. What is it for? I just made up completely a value to, I don't know, to 100,000 billion. I have no idea how much it costs to rebuild that house. You can then code this kind of things, understand a little bit some scenarios around the losses, and then when you run that in the model, you can get what we call this average annual loss, which is the loss that happens on average every year. Okay, my billing value is pretty big, so this is a big loss, but of course they don't see that every year. But on average, on the long term, this is what we see for earthquake, for windstorm, for floods. And this is typically one thing that comes directly into this, the design of the insurance premium. And you can imagine, you cannot say how much I need to insure or to ask as a premium to this for that building. I never have observed an earthquake risk for that specific tower. I have no idea, right? So I need to have a model to do that. So without models, you cannot get basically this kind of data that comes into the premium, or even this kind of losses that could happen on average every 500 years. You understand typically that this is the way the model can deliver value if you want. So just to close, I think what is the concern at this point of time? I discussed a little bit, quite a lot about earthquake and windstorm risk. This is what we called in this industry peak peril, because this is the peril that happens that could be very damageable. But now, over the past few years, there was a lot of concern about what we call secondary peril, and I hate that term, so I call it high frequency more, because they are no longer really secondary. We have seen last year in Italy, they had a multi-billion loss hail. 2021, all of you remember probably what happens in Germany and Belgium. And then we have the wildfire. That's again, it already restarted in Canada a few days ago. I've seen that, and so on, and hail as well. So now the big concern is coming also into this kind of the emergence of those kind of perils, if you want, and they are very tricky to model, right? And one of the main problems we had in the past is that we couldn't create a very realistic model. We had, for example, if you take like a flood model for Europe, we had to build it by country. It doesn't make any sense. Flood is not stopping at political boundary, but just because we didn't have the computing power, those models, they have to be run on premise, on computer at the insurance company. So if you have millions of events to be run, this is impossible. And now, what has changed over the past 5 years? It looks a bit stupid to you, I guess, but that's the fact that we can now move the modeling to the cloud. But this is a big business for this industry. This is heavily regulated. Some countries, they say, I cannot have the data outside a specific country. That's one, it's a problem. But if now we manage to change the rule, if you want, and now we can move to something that we're just country by country, to something that is much bigger. And if you have bigger model, much higher resolution, you can much better model the risk, typically the correlation that could exist typically between, let's say if I take the flood correlation between Paris and the rest of Europe, you can now have a very realistic map of flood correlation, flood risk correlation. You see there is a correlation through the river system, of course, but typically Frankfurt is correlated with Paris. There is no direct river connecting those countries, but when it's raining in Paris, it's raining in Frankfurt as well, very likely, right? So we can now model in a much more realistic way. We don't need any more with this kind of big model to create some shortcuts and simplification. And we can deliver very interesting things in terms of flood risk. As an example, we can now have the split between the flood that is due to the river. They call that the fluvial risk. So the flooding in the floodplain, if you want, and the pluvial, which can happen everywhere. And an insurance company with those models, they can start to run their exposure by commune, as an example, and understand that some communes are completely controlled by this risk of pluvial risk. They are never observed the claim, but if southeast of France is one example where very often, right, we have those phenomena. It's typically one thing that could be extremely dangerous for them, right? They have never seen any data, any claims, any losses, but they can understand that this commune, even without any losses observed, is completely driven by this kind of peril. And before that, with the model we had, it was very tricky to model this kind of split and the hydrology in a very realistic way. But again, here I'm talking really modeling the risk for the entire continent. So we are much less high resolution than what you can do for just a specific catchment. but we want to try to find a solution that is globally everywhere. And we need, of course, to include, again, finding solution to understand how flood defense will perform, as an example, and also the possibility for clients to adjust that. And also, of course, now we can expect now, that's the record we had, I think, in our model. That's the North America wildfires, 93 million of events. So we can now manage to model all the kind of sources of damage that could come from wildfire. It's not just a fire. A lot of typically damages come from smoke, right? The smoke can destroy a building and it's no longer usable. So we need to be able to model that. It's very complicated, right? And now we can pretty sure that with the model we can better model what could happen to that house, or actually what didn't happen, right? Because in this one, typically, it's like an interesting element to see that after that, it didn't burn. So that's showing it's the uncertainty. But that shows also one thing is that my characteristics for the buildings are very crude. Now we develop a lot more what we call secondary modifier, which is basically typically all the retrofit you can have for earthquake, all the system we can have to protect the house. This can be factored out as well. So there's as well a lot of research on the vulnerability side. It's just on the hazard side, but also on how to transform or to transfer that into something that makes the risk more realistic, even at one location level. And just my final slide to show you a little bit as well, that one thing we do a lot now with those models is that it's becoming more and more complicated to work with those models. They're becoming very complex, so we are all scientists. We all love writing scripts and codes to extract things. So you can, in the model, you have a user interface, and this user interface gives you this average annual loss, this written per loss. But if you want to ask a question, I don't remember, for example, let's maybe that question, or let's say, what are the top 100 locations in the US in my portfolio that are subjected to a hurricane category 5 every 200 years, as an example. You need to write a script to do that, right? And usually you have to have people knowing how to do that, or a piece of code. So we also have now a lot of this kind of element that's happening with this generative AI, this ChatGPT, if you want, as an example, right? Where you can ask this kind of question in plain English or French or in German, and then get the output out of that. And that it's interesting because it's basically enable some more efficient use case of those models. And I think it's re-adding some more capacity to use that for business, especially for non-expert, I would say. Okay, so hopefully this gives you like a quick overview on that. The idea is that, of course, it's not to spend too much time about the topic, but it shows you some elements, I think, that probably answer a little bit of those questions. The first is that, well, of course, we are doing a lot of our own research, but we rely on what you do, right, into your very specific area. So we, of course, when you talk about climate change, about seismic, about we interact with the national geophysical societies. We collect the data they are measuring. We read the papers that comes into that. But very often, one of the challenges we have, I would say, is to find a way to scale up that element, right? To basically move from one side to one continent or one country, right? That's one first challenge. This is where we have a lot of research done, I think, on our side. And I know it's not a very interesting topic for research, and I guess this is why it's done by the industry, right? But that's basically one of the challenges we have, right? I think this kind of element of being able to produce maybe less accurate view of risk, but more broadly. And I would say, I think the long-term perspective for research for us, I think maybe it's a more question I have based on what I explained, or you could find some ideas around that. But I would say the idea is that really, for us, it's more trying to factor I would say a lot of this uncertainty into the losses, into this kind of secondary peril, into the impact of climate change. So I'm more talking less about seismic, but about the weather risk. It's a big topic for this industry. And especially now because it's not only touching the insurance system, but also the banking system. The banking, they are more and more engaging, I would say, on what could happen on the long term. And insurance, every year, they can change their risk profile. They can say, we don't renew this insurance policy. It's renewed every year. A bank offering a mortgage, they are engaged on one specific building for 10 years, maybe. So they want to understand the long term. So all the long-term elements around climate change is important. And I would say also one thing that's important is the teleconnection. As I said, the fact that one site being affected, how this is connected to other side globally. So that's, I would say, the kind of things we are asking questions. We are not that good at this point of time to model that. But yeah, of course, hopefully this gives you some kind of quick idea about what we do and maybe some inspiration, I think, to pass us some ideas or even to join us at some points, right? I think if you're interested, because you see, that's, I think people, I think, I would close on that. I think my colleagues in development, they have it's probably a very high retention rate in this business. I don't see people changing every 5 years job, which is probably a good sign. So that's good, right? I think that's, for me, it's a good sign. I mean, I've started 16 years ago and I still see people in development still there. I mean, they seem to be happy, right? I think they have a lot of budget, a lot of money, I guess, as well, right?
It is correlated with the salary, just to guess.
The salary, yeah, of course, that's for the development. But of course, I think the fact also they have a lot of capacity to build things and to collect things, I think. Typically, if you take one of those models to give you a sense, I think if we develop a windstorm model, that's maybe a team of 10 or 15 people, hazard and vulnerability, and that's a budget of 5 or 6 million, right, to do that, because we have to buy data, we have to develop stuff, we have to develop. I mean, we are the computing power. We need to develop the stuff and so on. So that's typical, and you understand the challenge is not to create something that is extremely appealing on the academic world, right? I think when you will not. It's not a research topic, right? You can get funding for that. I want to build a European model for the insurance. Well, no, it's not interesting, right? But so this is why you see the kind of development being done in the industry mostly, right? But yeah, it's not just taking what exists. We need, of course, to develop the original things at this point, right? Okay, a lot of talking. Hopefully this was kind of overview, right? But